At the macro level, post-elections, we are beginning to see a pickup in economic activities, which we expect should continue in the second quarter of 2019. Union Bank remained profitable in the first quarter of this year. Supporting this profitability are also some very good underlying operational results. Before I go into the numbers, there are 3 points I would like to touch on. First, we're focused on optimizing our loan book, which will lead to a more predictable earnings growth. And we are very pleased that our NPL ratio, our non-performing loan ratio, has continued to trend downwards as our asset quality continues to improve. Second, as part of our 100 billion commercial paper issuance program, we raised 23 billion naira from the domestic capital market across tenors ranging from 90 to 180 days. This shows investors' continued confidence in our strategy and growth. We have witnessed increased activities in some key sectors: manufacturing, agriculture, general commerce, and the retail sectors. And we expect to see more with emerging opportunities in these sectors as we continue to create selective risk assets that meet our risk assessment criteria. The dip in our earnings this quarter was driven by a lower loan book base, which we saw from last year. The group's resilience in a challenging environment is demonstrated in these first quarter numbers. While gross earnings declined by 5% to 37.7 billion naira from 39.5 billion in the first quarter of 2018 due to our loan book resolutions from the previous year, our non-interest income grew by 39% from 7.8 billion to 10.8 billion naira. This is a testament to our ongoing debt recovery efforts, improved fees and commission income, which actually grew 13% year on year, and then dividends from our investments. We have seen significant increase in our credit-related fees as our loan book continues to get rebuilt. Our non-performing loans have come down to 7% from 8.1% as at December 2018, as we remain focused on optimizing our loan book. Operating expenses increased marginally by 4% quarter on quarter, reflecting a couple of things. First, an adjustment to staff compensation at lower levels to strengthen our workforce. This was done in the second half of 2018. Second is the increased depreciation expenses from our technology investments to strengthen our treasury, trade, and transaction banking platforms in 2018, in line with our desire to lead in the transaction banking space. However, with the commencement of our long-term efficiency acceleration program, LEAP, we expect to record savings on expense lines in 2019. While our deposits grew by 1% in Q1 19, we had a 4% growth in the low-cost deposits area. This growth in savings and current accounts deposits saw our low-cost deposit mix improve from 71% at the end of 2018 to 73% at the end of Q1 19. Notwithstanding a challenging macroeconomic backdrop, the group improved return on tangible equity to 9.3% from 6.8% at the end of December 2018. The bank remained well capitalized with a capital adequacy ratio of 16.5%, which provides room to grow quality risk assets as the economy recovers. Within this low-yield operating environment, profit before tax was maintained at 5.4 billion naira, consistent with first quarter in 2018. Our focus in 2019 is to leverage our platform to deliver efficiency, seek to maximize value across all areas of the bank. Now, regarding our loan book, we have started relatively well in Q1 2019 as we added 20 billion naira into our loan portfolio. By the end of the year, we look to grow our loan book by between 10 and 12%. Our loan growth will be driven by our focus on specific sectors of the economy, and these are manufacturing, agro-processing, general commerce, retail, and the SME space, where we are looking to scale our loan volumes on the back of our robust decision engine. For the rest of 2019, we are focused on a return on equity play, and this we'll do through rebuilding our loan portfolio, driving down our cost base through Project LEAP, and enhancing our transaction banking. Thank you.